Hi there, I'm Paul Bagnall. Welcome to Market Call today on BNN Bloomberg. David Burrows is our guest today. He is President and Chief Investment Strategist at Barometer Capital Management. He'll be taking your questions on North American large cap stocks. So get ready to call us toll free. In fact, pick up your phone right now and do so. Our number is 1-855-326-6266, or you can send us an email at marketcall@bnnbloomberg.ca. So that's how to reach us. David Burrows is our guest. Welcome, David, as always. And we'll get David's views on the state of the markets. It's been a good week for U.S. markets in particular, and you and your colleagues at Barometer remain bullish on equities.
Yeah, things turned up in October. We had a little pause to refresh in April, about 5.7% pullback, which tends to happen 2 or 3 times a year. But breadth in the market has been expanding. There's some really core areas of leadership. And in the end of the day, we need to own assets to help offset some of these inflationary pressures that we're seeing, and money is working its way into those areas of the market.
And you are doing so, I gather, by building portfolios built on dividend growth, although you're not going into all areas of dividend-paying stocks. Explain that strategy.
Well, look, at a time when yields have generally been sticky and moving higher, things that pay high dividends but that have relatively low dividend growth act a lot like bonds. And we would prefer to have companies that are steadily growing their dividends and buying back shares to help us offset the impact of rising costs of living. And so while the game plan over time has been to own high dividend paying stocks, it's a different world we're in today, and likely we could see rising rates sort of for 10 or 15 years. And we're going to want to have dividend growth to help offset that.
That means then no or very few telecom stocks, and we get a lot of questions on the BCE dividend yield, for instance, on this show, consumer staples or real estate investment trust REITs.
Yeah, these are things that are generally hurt by rising rates. They were helped during falling rates, and it's just a different game plan for a rising rate world. So really important to make sure that we find those characteristics.
And you've brought us a chart as well. You believe that the energy, materials, and industrials are undervalued. Here's the chart. I'll just briefly explain it to viewers. The white bars are so-called new economy stocks. The blue bars are so-called old economy stocks, which would include things like materials and industrials. Moving from left to right, those bars mean price to free cash flow, price to earnings next 12 months. So that's a forward-looking PE multiple. The third one is enterprise value to EBITDA next 12 months. So forward-looking on that multiple as well. And the final one is price to book. And I believe what you're going to conclude here, David, is that the blue bars are telling us these sectors are under-owned in the stock market right now.
They're under-owned, they're less owned, less loved, and they all have operating leverage. So if they're able to raise price, they're able to add profitability and cash flow. And these are all sectors that have an ability to raise price tomorrow if their costs go up today. And so these are things I think that are important to focus on. And in many cases, we have shortage of supply across each of those sectors.
That's David Burrows and his initial thoughts on the market. Of course, we'll take a look at David Burrows' past picks in the course of this program, and we'll conclude with his top picks on this day. We'll take your questions, however, on North American large cap stocks right after this. Okay, this is Market Call. David Burrows is our guest. Let's get to your questions to David. Carol has written us an email. Carol writes as follows. Could you ask Mr. Burrows what the one-year target is for CNQ? And that, of course, is Canadian Natural Resources.
Yeah. So this is a favorite stock of mine. It's one of our top 10 holdings at Barometer. We own it because they will have likely 20% dividend growth going forward on already a very strong dividend to begin with. They're returning capital to their shareholders. And we think that we're in the early stages of a longer-term commodity bull market. So when you ask me about a one-year target, I'd hate to give one. What I will say is that, the stock had a great run-up from the beginning of January into the beginning of April, and most energy stocks pulled back a little bit. That's fine. But we think this is like a 5-year story or an 8-year story, and one that you should probably have in any Canadian equity portfolio.
Okay, and I can tell you, Carol, that among the analysts who cover the stock, there are 22 who cover the stock, 13 say buy, 9 say hold, and the price target, the 12-month price target that's derived from those analyst ratings is almost 113 Canadian dollars per share. The stock is up 104 right now. Thanks, Carol, for your question. Let's go to Anita. Anita's in Markham. Hi, Anita.
Hi, good afternoon. Thank you so much for taking my call. My question is on Intel. David, could I have your thoughts on this company, please? In spite of the government injecting money into it, it hasn't shown much at all. Is it worth buying it on the dip, or should I ignore it? I'll hang up and listen to you. Thank you so much.
So the semiconductor sector has been a key sector for the market over the last couple of years. It tends to be a pretty good indicator of expectations for economic growth, and of course, AI plays right into the semiconductor space. Our big holdings have been NVIDIA and Broadcom. Both have done obviously very, very well. Intel has just had a really hard time executing. They are having a hard time being in the right space. And so when you've got a sector that's been strong and a very weak stock against it, I would not be a buyer. The difference between where a momentum investor stops buying and where a value investor steps in is a big difference. And certainly, Intel is becoming more of a value stock, but it's hard to make money in value technology companies.
Okay, thanks, Anita, for your call on Intel. Let's go to Frank. Frank's in Scarborough. Hi, Frank, and what is your question to David Burrows?
Okay. I would like to ask him about Bombardier, and I have the stock for about 13, 14 years. Now, could you tell me, I would like to ask David, give me 5 seconds.
Okay. So we don't own Bombardier currently. We probably should. We do have quite a lot of holdings in the aerospace sector. Obviously, some of the companies more defense focused. But the business jet business is very strong for everybody. And so they're benefiting in that world. They've done a great job in reporting their earnings. It's most recently taken out, the highs from 2022. So technically it's set up pretty well. Again, this is probably one that we should own, but we don't.
Okay. Thanks for your question on Bombardier. There's the 5-year return on Bombardier. Pretty darn good. It, of course, shifted several years ago from commercial aviation to the business jet model. Let's go to Ted. Ted's in Newcastle. Hi, Ted. Thank you very much for calling.
Hi. My question's on the Bank of Nova Scotia. I really like the dividend, but I'm wondering, should I buy that now or wait a week and a half after the earnings come out? Thank you.
Look, this is a bank that is working its way through its new identity. There are likely lots of changes coming with new management. And in the first couple of quarters of new management, often you get things thrown into the kitchen sink. So we're not buyers of lagging companies. We tend to focus on those that are performing, best in the group, because if you're in a bull market in a sector, you want to own the strongest because they're generally the ones that continue to take market share. Our biggest holding in the Canadian landscape is National Bank, and they've done a really good job of growing. So I would personally wait to see positive changes take place before I bet that they're going to happen. Mm-hmm. So it's great to get a good dividend, but this is all about total return, right? Get a dividend and some capital growth, and there's better capital growth in other banks at this point. So I would want to see positive change taking place first.
Okay, thanks for the question on Scotia. Let's go to Elliot. He's in Hamilton. Hi, Elliot.
Good afternoon. A few percentage points below its high. What's your assessment of CME Group, the company and the stock? Is it now fully valued or fairly valued, or do you still see room to appreciate? Thank you.
So one of our themes that we're focused in is financials as a whole. To give you an idea, just about 25% of our firm assets are in the financial services sector. Now, we own insurance and we own banks, but we also own the TMX Group as a holding. You know, we think capital markets are in a pretty good spot, and we think volumes in general are rising. So CME Group would play into that. The relative price performance is not near what you would see from the TMX Group, right? It's a much stronger relative strength stock and a little bit clearer as to where the growth is coming from in their commodity trading platform. So I prefer that, but you probably do okay in CME Group.
Okay. Thanks, Elliot, for your question on CME Group. Let's go to Sam. Sam's right here in Toronto. Sam, thanks a lot for calling.
Hi, I would like to have your opinion about United Health Group. Is it a buy at this price? Thanks for your comment.
Okay. So if you were to take a look at the healthcare sector, and you can do that by looking at the XLV ETF, you would see that despite the fact the price is moving higher, the relative price performance versus the market is moving lower. So we're in a market where there's dispersion, meaning certain sectors doing really, really well, certain sectors doing less well. Healthcare is one that probably has some political risks over the next few months, both sides kind of taking shots at it. So we have a very, very low weight. I mean, we own Lilly for the GLP-1 weight loss drugs, and we own Vertex, but outside of that, we own no managed healthcare. And so I just think there might be better parts of the market to focus in. If you look at it, United Health has traded better than only 39% of the companies in the S&P over the last 52 weeks, and the relative strength has been falling. So I would avoid this for now.
Okay. Thank you for the question on United Health. As you can see, a big performer over the past 5 and 10 years. We'll be back with David Burrows. He's President and Chief Investment Officer, strategist rather, at Barometer Capital Management. He'll be taking your questions, continue taking your questions on North American large cap stocks. So don't go away. Welcome back. Let's keep the questions coming to David Burrows. Nazar is in Scarborough. Nazar, thanks again for calling into Market Call. What's your question to David?
Oh, hi, Paul. Hi, David. May I have your thoughts on Sun Life Financial, please? Its quarterly earnings reportedly were surprisingly a disappointment, and the stock price dropped from a high of 73.50 to 68.50. In a higher for longer interest rate environment, is it a buy here, or would you rather buy Manulife Financial instead, which has had a great run since its last quarterly results? Thanks for taking my call.
So that's a great question. We like insurance as a group. They do benefit in a rising rate environment. Certainly higher yields in the bond market help them. Better stock market helps them. I go to a very simple saying. I want to own good getting better, not broken getting fixed. And I'm not saying Sun Life is broken, but listen, follow the numbers. Technically and fundamentally, Manulife is executing. And they're really benefiting in this world. I would be more focused there. On a relative basis, you know, Sun Life is underperforming. Again, when you get into a strong market for a sector, find the leader. The first stock to double is the first one to double again. And so I would just focus on Manulife and not try to get too cute, you know, picking up companies that you're hoping are going to get swung back around.
Okay. Thanks, Nazar, for your question. Let's go to Andre. He's in Chilliwack, BC. Hi, Andre.
Hey, good morning, Paul. Thanks for taking my call. David Burrows, thank you for coming on. You're the most bullish portfolio manager I've ever met. You always want people to buy. Good for you.
Could I get your thoughts?
Well, I don't think that's true, but it has been true for the last 3 years.
Could I get your thoughts on Enbridge? Would you represent? Does it represent good value at this current point? Would you buy more? It's got 28 years of increased dividends, and it helps me in this economy. Your thoughts, please. Thanks, fellas. A good weekend.
You too.
Yeah. So, look, we don't have a lot of pipeline exposure. The group has had a tougher time over the last couple of years. We do have exposure to Pembina, which I think looks very good, and they're benefiting from some of the strength in oil sands and so on. We don't own TRAP. We don't own Enbridge. Again, we're looking for a little bit more dividend growth. I think Enbridge is a well-managed company. They're very careful in the way that they deploy capital, but it's not on our list currently. Again, the relative strength versus the market has been weaker. When we look at utilities or things that are like utilities, we're actually more focused on electricity, and that's relatively new. In the last 2 months, we've added 2 holdings in the utilities because of demand growth for electricity, and we think that that's more attractive.
Okay, thank you for that call, Andre. Let's go to Chris in Calgary. Hi, Chris.
Hey, folks. Great work over there at Bloomberg. Thanks a lot. My question's on Costco. Bought some a bit ago. I'm looking at about a 2-year hold. Your thoughts and perspectives on it and its peers would be appreciated. Thanks a lot. I'll hang up and listen.
Hey, Chris, thanks for asking about that. Costco is one of our top 10 positions at Barometer. It clearly, you can see the chart, has been a very strong performer. If I look at consumer discretionary, it's a sector that is actually really having a hard time in the U.S. If you look at XLY, which is the ETF, it's weighted based on the size of the components. Relative strength has been waning steadily now for months and months. And that's partly because the consumer is being pressured by higher interest rates. So there's all kinds of companies like Starbucks or McDonald's or Lulu here in Canada that have had a hard time. The one area of strength have been the sort of value retailers. And Costco and Walmart in the U.S. are dynamite. They continue to gain share. In Canada, Dollarama has been tremendous. We own Amazon, same thing. That is the place in the consumer that we would focus. And so I have no problem buying Costco here. You know, they just have such a strong member base, and their revenues are so consistent. I'd be there.
Okay, thanks for the question on Costco. Let's go to Ben. Ben's in Bancroft, Ontario. Hi, Ben.
Good afternoon, gentlemen. Thank you for giving me the opportunity to ask a question. And the question is on Apple. With the newcomer to AI and buyback and all, what is your opinion? Do you folks own Apple, and what would be your outlook for the next couple of years? Thank you. Thanks.
Great. So we sold our Apple in December, and so we do not own it currently. Part of the reason was, waning revenue growth and earnings. And, it's not inexpensive if there's no earnings growth. Is there an opportunity for AI? Absolutely there is. And it sounds as though they're going to work to incorporate AI more into Siri, and that would be an opportunity for them. But as a firm, we're only about 10% tech versus 28% for the S&P. So that tells you that we think that there's other sectors that are less owned, that are less crowded, that have better value. Apple's a wonderful business, and I use all their products, but we don't own the stock.
Okay. Thanks for that question on Apple. Let's go to Carl. Carl's in Toronto. Hi, Carl.
Hi, Paul. Thanks for taking my call. David, I know you've previously been a fan of ATS Corp, and as I'm sure you're aware, the stock price has struggled a bit over the last year, likely due to perhaps a slower than anticipated transition to EV, and they also had a financing in March. They just had some earnings recently that were pretty good. The stock price has bounced back a bit, and most analysts have targets in sort of low to mid-60s. So my question is, are you still a shareholder? And if so, how do you view the company going forward from this point? Thank you very much. Cheers.
So we did own the stock about a year ago. We got stopped out at $55. So we use stop losses on all of our positions, and sometimes it saves us from some heartache. We try to make sure that a little mistake doesn't turn into a big one. After that, ATS did rally to a lower high and then went lower. So it looks like it's trying to make a little bit of a turn here. It's too early for us to get involved. I'm not saying it can't. They are in the right space. If we look at what's happening in the U.S. and manufacturing, advanced automation is something that is for sure going to have a tailwind. It's now trading on the NYSE, and so it's a broader audience for the company. So it may well be that it can make a turn here. It's just too early for us to put our money to work here. I think it is a good business.
Okay, thanks for the question on ATS, a former holding at Barometer. We will take a quick break. When we come back, it will be time for David Burrows' past picks, right around the corner. Welcome back. Time now for past picks. We'll travel back in time to April the 3rd. Of 2024, so not that long ago. JP Morgan Chase was a top pick on that day. Ticker symbol, of course, JPM on the New York Stock Exchange, one of the flagships of the U.S. financials, the flagship in the minds of many. Recommended when the price was about 198, now trading at just under 204. That's a return and total return of 3%. David?
I think that we've chosen this 3 times over the last 3 years. It's a top 5 holding at Barometer. When I talk about owning good, getting better, this is sort of a poster child. If you looked at the XLF ETF, which encompasses all the financials, it rolled over in 2007, did not make a new high till 2021. JP Morgan made a new high in 2013. So that tells you almost everything you need to know. They've invested more money in technology than anybody else. They've got the best balance sheet. Arguably, they've got the best management. and this is a company that can continue to take market share, which is why they shepherd broken banks into their hands, which they invariably make a pile of money on.
Yeah. How important is Jamie Dimon to the JP Morgan story? Because there are no indications that he's leaving anytime soon, but he's been there for a long, long time.
I won't underestimate his importance. He embodies what JP Morgan is. He's very, very cautious and very conservative. But they are ruthless in business, and I want to be on their team.
Okay, let's go to the gold sector now. Alamos Gold was a pick in April of this year, AGI on the TSX. It has recently made an acquisition, recommended at $20.10, now trading at just under 23. That's a total return in about 6 weeks' time of 13%. David?
Yeah, this is a really good intermediate or junior gold company. Their assets are in safe places, Canada and Mexico. It's about a $10 billion market cap. I believe that we are early stages in a precious metals bull market, and I'm not a gold bug by any means. However, technically the setup is very strong. The chart consolidated over about a 5-year period before it started breaking out. It's consistently making higher highs and higher lows. I think that this, it's up, I think, 7 or 8% today. So it can always pull back. Having said that, I think that this is a very good little company.
Okay. And number 3 on April the 3rd of this year, Imperial Oil, one of the big players in Canada's oil patch, an integrated player, recommended.
Yeah.
Just under 98, now at 94. That's a decline in 6 weeks' time of 4%.
Yeah. We own Imperial, we own Suncor, we own CNQ, all for the same reasons. Good long life assets, great dividend growth, lots of capital being returned to stakeholders. Their cash flow likely will continue to grow nicely. So if you could get rising earnings, a rising dividend, and I will argue a rising multiple as people build energy weights back into their portfolios, total return should be very strong.
Okay. Those are David Burrows' past picks. We'll be back with David right after this. He's President and Chief Investment Strategist at Barometer Capital Management. He'll continue taking your questions on North American large cap stocks. Okay, let's keep the questions coming to David Burrows. Chris is in Calgary, and he's our next caller. Chris, thanks a lot for calling.
Yeah, this is the other Chris from Calgary. My question is with regard to RBC. I'm up about 25% on RBC in the last 6 months, and it's close to its all-time high. So I'm wondering, is it time to sell, or should I set up a stop loss on it? Thanks a lot.
Okay, so let's take the lens back. We just went through a 25-month cyclical bear market from December of 21 through January of 24. Market made a new high, and then the TSX and the NYSE are making new highs. So we think that we are into the next 4-year cycle, and we think that that started in October of 22 when the market made its low. So we think that there's some running room in front of us. We made a generational low in interest rates in the summer of 2020. As somebody I really respect said to me, we've gone from 40 years of falling rates where the borrower was in control to what is likely 25 to 30 years where the lender is in control. And if that's the case, you want to own banks because they will make profit on the spread. If you think we're in a decent capital market business cycle, then you want to own a wealth management business, and RBC is by far the dominant player in the Canadian world in that, and they're doing a good job in their U.S. business. I think they are now 8th biggest capital markets dealer in the world. So it's pretty hard to bet against RBC at this point. So I would be a holder. This will be a dividend grower. We like the sector, well-managed company. I'm not going to fight that.
Okay, thanks, Chris, for your question on Royal. Let's go to Ron. He's also in Calgary. Hi, Ron.
Yes, hi. I'm a third-time caller over the years.
Right.
Paul and David, I'm phoning about NextGen Energy. A couple weeks ago, they had purchased $250 million worth of uranium for collateral, and they're an undeveloped mine. And the only thing I can see why they would do that is because they must figure uranium is going to go up dramatically from here.
Yeah.
Now, I'm bullish on uranium myself, so I just wanted to get David's view of what he thought.
Right. So we think there is going to be very strong demand growth for baseload energy. And really the only way that we're going to wind up supplying it is with nuclear power. That's our view. And so we're seeing nuclear projects announced around the world, and that's going to need uranium. We've got geopolitical problems that mean that Eastern European uranium may be less available. So, we own Cameco, right? Now, Cameco, unfortunately, sold a lot of their uranium forward, and they're short the spot market, so that's costing them some money. That's a negative. NextGen Energy has a wonderful resource and a great opportunity to develop it, and they're waiting on some licensing news. I will admit that $250 million financing to buy your physical uranium made me scratch my head. So I think that's not great. Also, management is compensated extremely well. I think the CEO's pay package is only $13 million. That makes me scratch my head a little also. So I owned some personally. I sold half of it on both of those pieces of news. But I am bullish on uranium. We own the URA ETF, which owns a number of the producers. We own the U.UN Uranium Participation Unit. We own Cameco, so we're there. But that is a question mark for me.
Okay, thanks for the question on NextGen Energy from Ron in Calgary. Pat's in Mississauga, and Pat's our next caller. Hi, Pat.
Hi there, gentlemen. Thank you for taking my call. I'm calling about Adobe. The stock has dropped off from its high in February. Just wondering what your thoughts are on this company and whether this is a good entry point. Thank you.
Yeah. So let's start with the sector. The software sector relative price performance rolled over in December and has had weaker relative performance since. And part of that is that, so many of these are subscription-based businesses. They are less likely to raise price tomorrow, as we talked about earlier. Adobe is one of the companies that is in that group that has struggled. So technically, the stock is a little bit broken. So we don't have a lot of software exposure outside of Microsoft, which is clearly in a position right now to monetize AI and is executing across all their businesses. So I don't think I would be a buyer of Adobe here.
Okay, thanks, Pat, for your question. Let's go to John. John's here in Toronto. Hi, John.
Yes, hi to both of you. I'm going to start with a joke here. I wish both of you were politicians because I could trust what's coming out of your mouth. And but David, I'm calling about copper, but I think more importantly, my call is about how much I appreciate when you're on the show. Just your honesty, your straightforward answers. You don't ramble. You let us know what you own or don't own. I just really, really like listening to you. So I could ramble forever. My question on copper is just: is it being overhyped? I know it's needed down the road, and I know it's going to be in big demand. But they're talking about 12,000 a ton and 15,000 a ton, and that worries me. I bought Copper Mountain, a junior out in BC. It was $2 or $3. Hud Bay came in, picked it up, $6, $7. I didn't know nothing about Hud Bay.
Okay, it sounds like we've lost his connection, but the question is clear. Copper, the commodity, and why don't you talk about some of the mining stocks as well?
Yeah, so we are bullish basic materials. In the S&P, it's about 2.48%. We're about 11% as a firm in basic materials. So that's a 4 times weight, the S&P. We own both copper, uranium, and then we own gold and silver. I think that we are in the early stages of a long-term bull market in commodities. If you look at commodities relative to bonds, they're winning. If you look at commodities relative to the equally weighted S&P, it's actually recently started to outperform. So we like the asset class. Of all of the commodities, I think there is the clearest picture toward a ramping of demand for copper, whether it's the thousands of miles of power lines that need to be replaced in the U.S., whether it's the EVs, whether it's data centers that we're building for AI. Copper is short globally, and as we know, it's very hard to put a new copper mine into production. So we own Teck Resources, would be a #1 position. We own a little bit of Foran Mining, which is a smaller company. We own another company we'll talk about today as a top pick. There's always risk of pullbacks. Having said that, I do think that we're earlier stage rather than later, and most people have avoided this sector. If you look at flows from investment managers, for 2 years they've been out of commodities because they just don't believe that it could perform the way that it can. And as a chartist, I would say it looks pretty darn bullish.
Okay, thanks for the question on copper. We'll be back with David right after this. He's President and Chief Investment Strategist at Barometer Capital Management. He'll resume taking your questions on North American large cap stocks. Welcome back to Market Call. Let's keep the questions coming to David Burrows. Claudia is our next caller, and Claudia's in Toronto. Hi, Claudia.
Hello. Yes, thank you for taking my call. I'm a first-time caller.
Great.
My question is on Interfor or the lumber. Is this a value stock, or is the sector doing okay? I mean, it's not doing okay, but perhaps it's a value stock.
Well, Claudia, so to start with the sector, you could pull up I spend a lot of time on ETFs. WOOD, which is the Forest Products ETF. Like many other commodity producing ETFs, it's performing pretty well actually recently. So the sector looks okay, but you have to pick your spots. We own Stella Jones, and we own because given all of the spending on infrastructure, they're selling a lot of telephone poles. I don't know if you look around your city. I know that near my neighborhood they're replacing poles.
Likewise,
they're replacing railway ties across the railroads, and so that's all going well. There are some questions, obviously, around new home builds, and so that's made it difficult on some of the lumber producers. West Fraser's acted okay. Interfor has not. So again, I don't want to buy a lagging company. If a sector is behaving well, I want to own one of the stronger stocks. If I had to buy one, I'd probably buy West Fraser, but we do own the Stella Jones as our #1 choice.
Stella Jones, ticker symbol, I believe, SJ, I believe, is the ticker symbol on Stella Jones. Okay, thank you, Claudia, for your call on the forest products. Let's go to Ara. Ara's in Montreal. Hi, Ara.
Hi, thank you very much for taking my call. My question is on $1.03. I bought Dollarama in 2 years ago, and in 2 years I doubled my money. So I said, why not buy the American cousin? And I bought $1.03, and I'm in a lost position today. And I heard recently that they closed 1,000 stores in the States. Is it intelligent to keep the shares now or dump them? Thank you for your advice.
Yeah. Well, Era, I like to say, don't let a little mistake turn into a big one. So if a company is underperforming its sector and they are not executing and they're having difficulty, move on. You know, in a decent market, we all know a well-diversified portfolio you can make with 15 to 25 companies. There's thousands that we can choose from. You only get good markets from time to time. Make sure they all are things that you would buy again today. And so stick with your Dollarama. I would move on from your Dollar Tree. Okay, thanks, Ara, for your question. Let's go to Denis. Denis in Cochrane, Ontario. Hi, Denis.
Hi, Paul. Thank you very much for taking my call. My question's on Baytex. I don't know if it's qualified as a large cap, but since the energy sector reported they've done pretty well, what's your thoughts on Baytex in the next 6 months?
I just don't think that they're executing. It would not be a choice for us. I would stick with, a company like CNQ, a company like Imperial Oil, a company like Suncor. We own ARC of the gas producers. We think that looks pretty good. They're all performing the way they should be, given what we think we know. So I would avoid Baytex for now. Okay, thanks, Denis, for your question from Cochrane. Let's go to Mina. Mina's in Calgary. Hi, Mina.
Hi, how are you? Thank you for taking my call. My question is on the TD Bank. I'm interested in TD Bank. What are your views about buying and holding for retirement? I'm going to hang up and listen to your answer.
Well, this is a very tough one because there's a lot of people who have owned TD for a long time and did not bank on some of the difficulties they've had recently. So they are under scrutiny for some of their anti-money laundering practices, and that doesn't seem to be going away. It seems to be getting worse. So this is one that I would avoid. We look at the Canadian operations, and they're wonderful, and for the most part, the U.S. they've always done a good job. But this is going to leave a mark for a little while, and I think that there are better places to focus. There are media reports. They're not confirmed yet. No decisions have been made, but there are repeated media reports that penalties, and analyst reports as well, who say that the penalties from U.S. regulators could involve some type of ban on making acquisitions for a lengthy period of time. That would be, I would think, quite negative for TD Bank. I just think that this is a focus for regulators, and they're going to make an example out of TD. So I would just go somewhere else. Mina, thank you for your call. Let's go to Ken. Ken's in Porcupine, Ontario. Hi, Ken, and thank you for your call.
Thank you for taking my call. My question's on BCE. Now, this might be a little late to the post because I added to an original position this morning. I'm quite interested to hear comments on BCE. Pays a pretty nice dividend. I would like to see a little pop up in the price of the stock, but thank you. I'll hang up and enjoy the long weekend. Shut those phones off.
Thanks, Ken. So estimates for 24 are for earnings to fall. For 25, they're expected to be flat. Yes, it pays a dividend, but there is no growth coming in that dividend, in my opinion. And so, we run a macro portfolio, and we're in a pretty good market. We're not short a lot of things, but I am short the telecom sector ETF IYZ. It just continues to relatively underperform. It would not be one that I would purchase, and I think that you will do better. If you want a dividend, go buy CNQ and get a 20% dividend growth over the next few years, and probably some multiple expansion. BCE is the parent of this television channel through its Bell Media division. We have a little bit of time for one more question. Mark is in Toronto. Hi, Mark.
Hi, thank you for taking my call. I've owned UPS for a while in my RSP, and it's gone up quite a bit, but for a long time it's stayed stagnant. If as a long-term hold, would you sell it and take your profit and invest it in something else, or would you hold it long-term?
Yeah.
And we need a fairly quick answer.
So I'm
here,
not good at buying turnarounds, but I'll just say this: when the market bottomed in October of 2022, the stock was trading at $210. It's trading at $148 today, and we've had a giant rally in the meantime. So what happens if the market weakens? I think that this is one you want to be cautious on. The transport sector, IYT, I'm also short in our macro portfolio. Transports have been waning a little bit. So in general, you're not getting help from the sector. You're not getting help from the share price. Relative strength has been caving. I would stay away from this one.
Okay, thank you for that question. And that's all the time we have for calls today. But thank you very much to everybody who put a question to David. And don't go away just yet, because David's top picks are coming next. Time now for David Burrows' top picks. Number one on this day, Freeport-McMoRan, FCX on the New York Stock Exchange. This is the copper stock that you said you would talk about.
Yeah, so this is an S&P 500 company. It's one that any institution can own. One of the biggest risks in owning a copper producer is execution risk. And they have shown over time their ability to execute and operate the mines that they have. They have had impressive volume growth from the Indonesian and American mines. They grew their earnings and cash flow really nicely, and their cash costs actually declined by 1%. So it's a long life asset. One of the things about an existing mine that has ability to grow is there are not the same risks as a greenfield development of a new mine. And so it's a lot of operating leverage, meaning higher prices can make a big difference to the cash flow. And you get about 20% exposure to gold through their production as well. So this would be a good one for almost any portfolio to get some exposure to basic materials.
Okay. Goldman Sachs is number two, one of the heavyweights of Wall Street, ticker symbol GS on the New York Stock Exchange.
If you are worried about the stock market and capital markets, Goldman Sachs should not be making new all-time highs. And it has broken out recently from a very nice base. They are executing. They grew their revenues by 16%. Their earnings were up 32%, which speaks to the operating leverage in this business. You know, they are the dominant investment banking franchise and trading franchise in the world. They also are gaining in asset management. So this is one that I think, again, could be right there alongside JP Morgan as an important holding for almost any investor.
Okay. And we'll go to the information tech sector next for Thomson Reuters. That's David's third top pick on this day, TRI on the Toronto Stock Exchange.
Okay. So that we don't get through an entire show without talking about AI, we're going to use Thomson Reuters as a top pick. This is, again, a top 10 holding at Barometer. Of course, they're in financial markets data, but their big businesses are law and tax and accounting, all heavily labor-intensive industries that are ripe for cost savings and insights from AI. So if you're a lawyer drawing up a contract, or you're a paralegal looking for a case law, AI is going to change the world, and Thomson Reuters is working very hard at integrating these into their existing offerings, which is going to give them lots of opportunity to generate additional revenue and cash flow from a very large business that they have to begin with, a great Canadian company to focus on.
Company does pay a dividend, but the yield is small. I'm assuming you're not buying this as a dividend play, correct?
No, we're not. And we're looking for obvious winners from the productivity that's going to come from AI. And Thomson Reuters has been really, really focused on that. They're making acquisitions in the area, and they just have a franchise that is unrivaled in the spaces that they're in. So great opportunity, I think, to own a great business. It's not just blue sky. but with lots of upside opportunity that comes from implementing AI.
David, on behalf of our viewers, thanks a great deal once again for being here on Market Call, and have a great long weekend.
Paul, thanks for having me.
David Burrows was our guest. As always, please consult. Actually, we're going to take a look at markets just before we say goodbye. Here's a look at the big three North American markets, including the S&P TSX Composite Index right here at home. There you see the S&P TSX Composite at 22,421, up half a percentage point for the year so far, up 7%. The S&P 500 essentially flat. That's flat in very nearly record high territory, of course. The S&P 500 up 11% so far this year. The NASDAQ Composite down very slightly, also in record high territory. It's up also 11% so far this year. Let's move on now to take a look at oil. We'll take a look at West Texas Intermediate crude oil. And we should get copper in there if we can as well. There's WTI. It's up about half a percentage point to 79.60. Here comes copper, and then we'll say goodbye. Copper trading at more than $5 US per pound. That is the highest price ever for the price of copper. And as David Burrows told us, he's bullish on copper and the copper mining stocks. Thank you so much for watching Market Call. Have a great weekend wherever you are around the country. We'll see you here on Tuesday, right here on Market Call on BNN Bloomberg.